Ever pondered how to maximize your intraday trading? Welcome to the exhilarating world of intraday trading, a realm where assets are bought and sold within the span of a single trading day. This strategy allows you to capitalize on the day's price movements, making swift short-term profits before the market closes. But success in this rapid-fire trading world doesn't come from chance. It stems from a robust intraday trading strategy, one that navigates the ebb and flow of market volatility and turns it to your advantage. This strategy is your compass, guiding you through the fluctuating landscapes of the market, helping you pick the right assets, define trends, set profit targets, and importantly, manage your risks. So buckle up, because we're about to embark on a journey into the dynamic world of intraday trading. Now let's delve into the tips that will help you become a successful intraday trader. Knowing the right assets to pick is the first step to successful intraday trading. Let's delve into the art of choosing assets. Volatility is the name of the game in intraday trading. Assets with high volatility are the go-to as they offer more opportunities to earn. Think of it like a roller coaster ride. The highs and lows, the twists and turns. That's where the thrill lies, and that's where the profits are. But how does one spot these volatile assets? Enter the economic calendar. It's your crystal ball into the future of price fluctuations. Major events listed on the economic calendar can cause significant price movements. By keeping an eye on these events, you can predict which assets are about to become volatile. Consider the economic calendar as your compass, guiding you through the choppy waters of the financial markets. It not only helps you find assets with upcoming volatility increases, but also gives you an insight into the market sentiment, which can be a precursor to predicting the trend. Once you've picked your asset, it's time to don your detective's hat and delve into some technical analysis. Your mission is to define the trend, find the best entry level, set profit targets, and place your stop loss. Being an intraday trader is like being at a buffet. You have a range of different time frames to choose from based on the liquidity of your chosen market, the amount of time you have to make your trades, and your preferred trading strategy. It's all about finding what suits your palate the best. Choosing the right asset is like choosing the right ingredients for a recipe. The better the quality of your ingredients, the more delicious your dish will turn out to be. In the world of intraday trading, the right asset can make all the difference. It can be the deciding factor between a successful trade and a missed opportunity. So remember to choose wisely, analyze thoroughly, and trade smartly. Because in the end, remember, the right asset can make all the difference. Ever found yourself second-guessing your decisions post-execution? It happens more often than you'd think. Doubts creep in, and you start thinking that maybe your entry point wasn't as good as you initially believed. This is where sticking to your pre-decided entry and exit prices comes into play. It's all about discipline, about not letting your emotions interfere with your trading strategy. The key is to decide on an entry point and a take profit level before entering the market. This means you've got a plan, a direction. You're not just riding the waves, you're steering your ship towards a specific destination. It's important to remember that the market is volatile and unpredictable. That's why the ability to stick to your plan, to trust your initial decisions, is crucial. It helps you stay calm and focused even when the market is in turmoil. So stick to your plan and avoid second-guessing your decisions. In trading, it's not always sunny. The market can turn against you. This is the reality every trader, whether seasoned or newbie, must face. But fear not, as there's a safety mechanism designed to limit your potential losses when things go south. It's called a stop loss. A stop loss is essentially an order to sell an asset when it reaches a certain price point. It's like a parachute that automatically deploys when you're in free fall, protecting you from crashing into the ground. It's this fail-safe that allows traders to sleep at night without the constant worry of losing more than they can afford. But why is setting a stop loss so important? The answer is simple. Trading is unpredictable. No matter how much research you put into it, no matter how many charts and graphs you pore over, there will always be elements out of your control. The market can shift in an instant due to an unforeseen event, and this is where a stop loss comes into play. It acts as your safety net, ensuring you only lose what you're prepared to. Now, let's discuss some popular methods of setting a stop loss. One method is setting it at a key level behind your entry point. This means that if the market price reaches this level, your trade will automatically close, limiting your loss. Another method is calculating the risk-reward ratio. This involves determining how much you're willing to risk for a potential reward. A common ratio is 3 to 1, meaning for every dollar risked, the potential return is $3. But remember, a stop loss is not a magic bullet. It doesn't guarantee profits, nor does it completely eliminate risks. It's a tool, a very effective one if used correctly, that can help manage your risks and protect your capital. In the end, it's all about making informed decisions and being prepared for any outcome. So remember, a well-placed stop loss is your safety net. It's your best defense against the unpredictable and often volatile world of trading. Use it wisely, and it could be the difference between a minor setback and a major blow to your trading capital. Greed can be an intraday trader's worst enemy. This sentiment rings especially true when it comes to taking profits at the right time. The market is a fickle friend, and it only takes a few minutes for trends to shift, particularly in highly volatile markets. The allure of holding out for those extra few points can be tempting, but the secret to successful intraday trading lies not in succumbing to greed, but in a high-leverage strategy that helps to increase profits as well as manage losses. So let's say you've reached your target. The price has hit the level you were aiming for. The natural instinct might be to hold on, to wait for the price to increase further. But this is where discipline comes into play. Don't wait, take your profit. Now, you might be thinking, but what if the price keeps rising? I could be missing out on more profits. Yes, that's a possibility. However, there are ways to handle this situation without letting greed take the wheel. One option is to divide your position and set several targets. This way, you can take some profit when the price hits your first target, but still have a remaining position in case the price continues to rise. Another option is to adjust your stop loss, trailing it after the price as it moves in your favor. This allows you to secure a certain level of profit while still giving the price room to grow. Remember, the aim here isn't to squeeze every last drop out of the market. It's to ensure consistent, sustainable profits. It's about making calculated decisions based on your strategy, not emotional reactions based on the fear of missing out. And this is where patience comes in. Patience in waiting for the right time to take profits. Patience in resisting the urge to hold on for just a little bit longer. Patience in sticking to your trading strategy, even when the market seems to be tempting you to stray. Remember, being patient and disciplined about taking profits can make all the difference. It's not about making a quick buck. It's about building a long-term, profitable trading career. Intraday trading is all about making the most of the current day's market trends. The strategy is simple. You open and close your trading positions within the same day. But why does it matter to close your positions at the end of each trading day? Well, let's dive into it. Firstly, remember that intraday trading is based on the day's market trends and technical analysis. These trends can change overnight due to a myriad of factors, such as fresh news, economic events, or market sentiment shifts. Therefore, a position that seemed profitable today could turn into a loss tomorrow. Think of it this way. You wouldn't want to leave your chess pieces in a vulnerable position overnight, would you? The same goes for intraday trading. You want to secure your positions and your profits before the market closes. Secondly, holding trades overnight can expose you to what we call gap risk. This is when the opening price on the next trading day significantly differs from the closing price of the previous day. Such price gaps can occur due to aftermarket hours, news, or events that can drastically affect the asset's price. If you're on the wrong side of this gap, it could mean substantial losses. Moreover, by closing your positions at the end of each day, you're also eliminating any overnight fees or charges. These are costs that brokers often apply to trades that are left open overnight, and they can eat into your profits over time. In essence, closing your positions every day is akin to hitting the reset button. It allows you to start the next trading day with a clean slate, unaffected by the previous day's trades. It can also help you maintain better control over your trades and manage your risk more effectively. So, ensure you close your positions every day and start fresh the next day.